Good evening, everybody. My name is Iyana de Buru, by special grace of God. I'm the chief technical analyst of a price action traders forum. I'm here to present to you the much awaited price action patterns which has been raving recently in the market, which I promise to introduce you into. Yeah. Please, I would like you to take, if I do it, well, I've done my part. If I would like you to take action on what I'm going to show you here. Try it for yourself. If it works, very fortunate. If it works for you, if you try it, if you apply the rules, the simple rules, APC, what I'm going to show you here, if you apply it, it works for you, very fortunate, which I'm very sure it will work. It works. Yeah, I mean what I'm telling you, it works. Because why it works is because it follows the basic truth, fundamental truth of the financial market. Yeah, that's identify the decision points, high probability price rejection pattern. Now let's go straight to the point. Why price action matters a lot? Because price action leads. I've come to a stage in my life, in my trading career, that I have to do away with all indicators. I have to do away with indicators. I have to base my assumption, my judgment on the price action. What is trading? Not what somebody in one place and code the program where I don't understand. I'm just like, what I can see. If I see it and I can interpret it, I can understand how it works. And whatever you can understand, whatever you can interpret, whatever you can define, you can manage. And if you can manage it, you are in control. You are in control, yes. If you cannot understand how it works, that's a risk to you. Yeah, ignorance is a risk. Yeah. So just buckle up your belt, or sit tight, take your pen. Then after this lesson, please go to your chart and see how this thing works. Backtest on it, apply it. Fine. You binary traders, I'm not a binary trader. This is the best slot for you. If you can know how to if you are very smart enough, you make hell of money. You don't need to depend on those binary, whatever they call it themselves, or whatever, the signals or binary bots or binary indicators or binary clinical. Just follow the candlestick, purely candlestick reading. It's all entirely candlestick reading. Just candlestick reading. Read the candlestick, the wick of the candle. That's all. Yeah. So you become very dangerous when you learn how to read price actions. You become very dangerous because price action leads. Price action doesn't lie. It leads. Yeah, it leads. So price action is just like a Warzone, which is the only truth. Rest all illusion. Yeah, can consider a Warzone. One enemy will never attack at one shot. How will they attack? Where will they attack? How do you know where they are hiding? How do you know how to protect yourself from the attack? Yeah, you must understand where the market makers are making a move. You must understand when they enter market. You want to understand, because they are coming to take your money. They don't trade stop losses. They only trade on what you don't know. They trade on what you don't know. They trade on your emotion. Yeah. But how do you escape yourself from this, illusion, from this, which enemy of army called the market makers? You can only do that when you understand when you understand how price action works through pattern recognition. If you can recognize pattern very well, oh, that's great. It's great. Yeah, I want to tell you what I got from Richard Walker. Richard Walker is a veteran in the market. He's a legend. He's died. He has died some years ago, but history history will never forget him. Yeah, history will never forget me. He called the market maker the composite mind. Yeah, he now quote it like this here: all the fluctuation in the market and in all various stocks should be studied as if they were the result of one man's operation. Let us call him the composite mind, who in theory sits behind the skins and manipulate the stocks to your disadvantage. They manipulate the market up and down. They take the stops here and there up and down. That's what they do. If you do not understand the game, he plays it as he plays it. You are gonna. And to your great profit, if you understand it, you remember I told you that what you can understand, you can move, you can control. Yeah, so that's work off for you. So he's advising the retail traders to try to play the market game as the composite man played it. You play with the rules. You follow their steps. You take money out of the market, even if it is 5% out of what they move in the market. You move with them. Yeah, that's it. Now tell this to your mind: our life is too short to learn from our own mistake. There's no holy grail for investing, trading, because you are really fighting with the institutions on the opposite side who have billions of dollars with world-class technology, human resources, blah, blah, blah. So hence, don't expect your RSI or indicator or whatever. If you still believe, if you are that type, you are listening to this, please delete all those things away from your mind. Open up your mind to this new concept of price action. Delete those things, those indicators you believe so much. Delete them off your mind. Let's just give it a try. Give price pattern a try to make millions. Yeah. Now, there are three things you must know about candlestick, because this is the foundation block of this pattern. Candlestick. There are three things you must know. There are three things you must understand about candlestick. How the Japanese read the candlestick. This is possibly one of the most important sessions of this candlestick reading series. So you must have learned different type of candlestick patterns before now. But to be honest to you, you don't need to memorize any candlestick pattern at all. If you know how to condense the candlestick, how to understand the language of price movement has been dictated by this. You don't need to memorize all those names. Harami, Doji, blah blah blah. More than 25 names of candlestick patterns. You don't need to memorize them. Just understand the movement of the action of sellers and buyers in the market. That's all you need. Once you understand these three things I'm going to show you, you can forget about all the candlestick patterns that you have learned earlier, because you can still read what the market is trying to tell you. I'm telling you, this is very powerful stuff. Very powerful stuff. So with that, the very first thing that you must know is the body of the candlestick. The body of the candlestick. The body. What is the body? The real body is where the real activity takes place. It's the trading volume. It denotes trading volume. It denotes the trading activity in the market. Yeah, the length of the body shows you who is in control. The length of the body shows you who is in control. Yeah, this is this. This is a bullish. Consider this as a bullish market. The bold green part is the real body. We call it the real body. Yeah. So that controls who is in, who. I mean that shows who's in control of the market, the body. So if you have a longer body, let's say a bigger bullish candle with a larger body, like this one we show you now. If you have this as a large real body, you know, it is telling you that the buyers are obviously in control. They're in control because of what the body is larger than the wick. We'll come to that, understand the wick. The wick, yeah. The length of the wick. That's the second point you need to understand. These two tiny things are the wicks. So you must compare the length of the body to the length of the wick. Yeah. If the body is times 2 of the length of the wick, that means there's a control, there's much activity in the market. If for example this now, in this bullish candle, you can see the real body is about 2 times the size of the wick, the 2 wicks. That means the bullish, the buyers are in control. Coming to the end of the trading session, the buyers were actually in control. So you must get to know the length, the size of the. You compare the size of the body to the length of the wick. So the length of the wick shows you price rejection. And I show you that the real body shows who is in control. The real body shows you the trading activity, the retailing activity, the follow. While the wick show you the price rejection, the displacement of price, the displacement of market participants in that trading session. Yeah, take note of that. The wicks dictates to you price rejection, where particular place where price has been rejected, that is the wick. While the body dictates the reactivity that takes place, trading activity that takes place in the market. Yeah. So where the price gets rejected at the highs, where they get rejected at the lows, that is the wick. That is the wick. That is the function of the wick. The third thing you have to look at is the ratio of the wick to the body. You need to know the ratio of the wick to the body to get a complete picture. Yeah, let's have a look at this. Let's have more look. Can you see it here now? If you can see, if you measure this very well, you say it's the small wick, and to the long body, what it denotes the buyers are in control. Yeah, but here we have this. We have small body, and we have, we have almost about times 2 of that of the wick. Times 2 of the wick. Then what do you say? We have just few buyers. So the trading range is relatively small. So there's no much trading activity, right? So there is a battle. This is a battleground between buyers and sellers. I'm just showing you. I'm just telling you this because this is a foundation block. This is foundation for most of you that are still new in reading price action. You got to understand this. Now if you get a longer wick than the body, that means you have a small body. Then the long wick, that means there has been a displacement of buyers by sellers. Can you see? If this body now represents the numbers of buyers, a bullish body, that means sellers took control of the market. Because of what? Because you see the length here. You see the length. This length were the number of buyers that were displaced off in the market. They were being displaced off in the market. So we can see over there in this first candle, you have a strong body close. A strong body that closed that close higher than the open, right? Buyers are in control. If you look at the wick of the candle, it is slightly short, so that there is there is not really much price rejection. This one you can state blah 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 blah. So I've really talked about this. I'm just yeah. So the most important thing you've got to know there is that the wick denotes price rejection, while the body denotes the retrading activity that take place. Just follow me, we'll get to where we are going. Yeah, so moving on, the opposite for the happens to the bearish market. Yeah, because of our time. Yeah, I may send you this thing. Just yeah, just relax. So that is so to recap, we say the length of the body shows who's in control, the length of the wick shows you the price rejection. Then to get a complete picture, you want to look at the ratio of the wick to the body in order to get a complete picture of the price action. Yeah. Now, reason why decision point, this price pattern, why does it work? Why does it work? What are the bases? Why does it work? Why price pattern works? I want to give this quote. I've been giving this quote, several times on the forum. You see me because I really want to put it in. I really want to instill it into your mind. This is why price pattern work. According to a veteran in the market, Jesse Livermore, he said patterns repeat because human nature has not changed for thousands of years. Human nature never changed for thousands of years. So that means history always repeats itself. It's one of the basic assumptions of technical analysis. History does repeat itself. So that means what happened in the past possibly will reoccur in the future. Yeah. So these patterns are recurring. They are recurring in the market because of what? Because emotion. We are human beings. We human beings trade in this market. So when we are trading, we flay out our emotion, greed, hopes, and fear. We're being exerted in the market. So whatever thing that you are coming, whatever emotion that you are taking to the market will be reflected in a price chart. That is the understanding of this quote. It will be reflected in the price chart. That's why we no longer bother about the news. Whether FOMC and NFP, who cares? Let them be released. When we get to the price chart, we know what to do. With your understanding of price action, you don't need to bother yourself about names anymore. Yeah. Then there's another veteran, Paul Tony Jones, is a hedge fund manager in the Wall Street. Yeah, he's a successful investor and hedge fund managers. He talks about the narrow range candlestick, which is the pattern decision point. He talks about it. He say if there is a sudden range expansion in a market that has been trading narrowly, human nature is to try to fade that price move. They fade it up and down. I told you the market makers do fade the markets at the top and at the bottom. They fade it. They fade that move. When you get range expansion, the market is sending you a very loud, clear signal that the market is getting ready to move in the direction of that expansion. Range expansion, what do you mean by range expansion? If you have something like range expansion. This is, for example, this is market is ranging. Market move up, it was ranging, it's ranging. So it's ranging. For example, it's ranging, you have a range here. Then you now have expansion. This is expansion. Market moves higher. Right? So this is a bullish. This is represented by, this is a bullish market structure. Have been represented by up close candlestick, right? So this one represents the range in the market, the ranging market. We call this the impulse or a trendy market. Why this too is a trendy market or the impulse. For you guys that are new in the market, so that's why I'm preparing this here. So now, so it is a range. This is expansion. This is expansion. So you know that this market, this is a continuation of the previous market. The expansion is a continuation of the previous market. Market move up, relaxes, and continues in the original direction. That is what that guy is taking. So the same way, if the market as market moves up, it comes down again to try to test, to rest again, then continues upward. That's how market moves. So that is what that man is trying to put to the Jews, try to understand it, that the market is getting ready to move in the direction of that expansion. In the direction of that expansion. Can you see it? Yeah. For example, this is a range. This is a range. This is a range. Right? And market moves upward. As it moves upward, comes down, then continue the journey. It continues the journey. This is a range. This is expansion of the range, where the Richard Wyckoff called this place as the accumulation or distribution area. You know, this is where the market they manipulate and what they distribute. Yeah. So you get to know in advance at the advanced course. Yeah. So that down. Here is the pattern. Here is the pattern. So that observation or knowledge of the range and expansion of it, and how the candlestick, the understanding of candlestick, the wick and the body will give you what happens, what this pattern represents. What does it represent? It represents simply a price displacement. Price displacement. Two market participants are fighting themselves. They fight and one gain an edge over the other. That's just what happened there. You see, that's just what happened. That is a decision point. A decision point is a particular point where two market participants are struggling to make decision. They struggle. One pulled the market downward, got a particular point, he could not take it, and the other one take advantage of that and pull it upward, opposite. That is decision point. And then the one that takes the market ahead of the weak hands has an upper hand. That's a decision point. He decided to take the market away from the rest. A decision point. He had decided a decision point. So this is the body, this is the wick. This is the body, this is the wick. The first candlestick, if this market is coming down, if this is the first candlestick, you can see that the wick here, instead of closing down, there was a push. There was a push upward to this place, right? There was a push. At the end of the day, the market closes here. Then the second session continues from where it closes downward. But before it comes down, before it starts coming down, it has been pushed upward. Are you seeing it? It has been the very first thing is to push the market upward, because you know the market was pushed upward by the by what by by buyers. You grab the point. By buyers, they push the market. The second session, they try again to push it higher, but they were being out. You know, they were being displaced by these aggressive sellers who came into the market initially with the full force. They were being displaced. You know, that's why I told you the market is a war zone. Yeah. Yeah, they were being displaced by because of what? Because of the financial pressure they come in with. They were being displaced by these sellers, right? So they were being displaced by, so they got to this equilibrium. We call this place equilibrium. There's a fair value of price here, a fair value. So when the number of buyers and sellers, when the price is at interacts, I mean intersect, that place is what we call the equilibrium. Supply and demand. Yeah. The amount that this supply and the amount that this be demanded is we are equal. So equilibrium point. So this is what we call the decision point. Decision point. Yeah, this decision point. So they took the market to this line and they push it down. At last, sellers gain control over the market. So this is a decision point. As the market tries to, as they come down again, as they are going upward, this place becomes a resistance zone. It becomes a resistance zone. Because of what? Because of the strong battle that happened here. This will become a resistance to buyer that will try to push this market upward and get this place. So this place will be, that means this place will be retested in the subsequent price movement. It will be retested. So it is this retest that we look up to, we will sell into. We are not selling here. We want to call the price to this place. We allow the price to come to this place. The market must come back here. The market maker must call the price to this back to this place, and it is from this place you will look to sell. It is from this place you will look to sell. So this the opposite of it is what happens to what the bullish structure of this decision point. I see it, market was going upward, it was displaced at last. Towards the end of the close of the market, it was displaced by sellers, right? They pushed the market to this point. Then the second day, or the second session, they put the market downward a bit. Then buyers, with their aggressiveness, they took the market above them. So this become a decision point. Equilibrium become a decision point. So as the market moves up, it will come back to retest this place. This zone will be retested. Because market maker will come to that place to take more stops that was being placed below here. They are coming down to take more stops because they believe that a lot of people will place their stop here. The market moves away from this place. A lot of people place their stops here, so they come back. And as you are placing your stop, when you put a stop loss for buy, that's telling you that you want to do what you want to. You want to sell out the market at a low price. So you are inviting the market maker to come and buy at a low price from you. So that is what will make this price to come down to this zone, right? So once they take order here, it will bounce upward again. So that is that for that pattern I've shown you. So weak rejection, we say weak rejection are formed by an extreme shift in trader buyers or sentiment. You will see a single candle push deep into a range, and then before the candle closes, be violently taken by the opposite market participants, who are the composite, the market makers. So because of our time, if you want you to be short, we go to the next. we stop this.